All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Happy Inflation Day, everybody. Today is March 12th, 2025. And of course, the top story this morning is the Consumer Price Index, CPI. And it came in lower than expected, a slight decline from last month. This is the first time in several months we've actually gotten a little bit of a sigh of relief when it comes to the rate of inflation. Now, as we go through all of these numbers, it's very important. Keep a few things in mind. When we're talking about inflation, you have to remember inflation is a rate of change. So if you hear inflation has gone up, that means price has gone up and it's gone up faster. If you hear inflation has gone down, that means the price is still going up. It's just going up slower than it was. And if you hear inflation was negative, that means prices actually went down, something we almost never hear about. All right. Every time, every month when we do CPI, there's always people who get these confused. It's important to keep those things in mind. Inflation is the rate of change of price. Okay. So that's important. So it was a beat all across the board. All right. Month over month, year over year, core inflation, headline inflation, no matter how you look at it, it came in lower than the market was expected. Also, guys, it's important to put that asterisk next to it. Yes, these are government numbers, and thus they are subject to the political wills and whims of the bureaucrats who assemble the data. It's the data we have. You can only report the data you have. We can't just make up numbers because we don't agree. So, we got to report what's stated here. Now, a couple of important notes within the CPI report, and we'll get into the chart and we'll show you guys the actual numbers. Food went down. And again, when you see it going down, price is still rising, but rising slower. Food away from home in particular, 0.0 for the month. We had no price increase at restaurants, perhaps a sign of the struggling consumer. We've seen a lot of restaurant chains had a really bad 2024. And even though food at home continues to get more expensive, restaurants were flat for the month. There's that R word, the possibility of a recession showing there. We had energy was actually a negative on the year over year. The price of energy cheaper than it was a year ago. Fuel oil in particular, a lot cheaper than it was a year ago, even though we've had a pretty cold winter. New vehicles went negative. Price of a new car went down in the last month. Now that, if you really think about it, that is amazing. Because what have we heard about all for over the last 6 months or so? Every major manufacturer of vehicles in the world is scaling back production. They're producing less. They're limiting supply. And yet price is going down, which means demand is falling even faster than supply. People cannot afford new cars. And for whatever reason, the auto industry, particularly in the United States, will not produce a more affordable car. They'd rather make nothing than a car you can afford. I don't know why that is, but it just is the way things are. So new vehicles went negative. Used vehicles, on the other hand, went up again. So it went up, but it went up a little bit less. Inflation is coming down. But again, there's no used vehicles. Nobody can afford a new car. And so everybody is being pushed into the used vehicle market. And remember, in 2020 through 2022, we had the chip shortage and we had the vid going on. So we didn't produce many vehicles in the earlier part of this decade. And now we have a shortage of formerly new vehicles becoming used vehicles. So there's just not enough used cars out there. You got more participants in the market. So the price of a used car continues to go up here. Shelter went down a little bit. Emphasis a little bit. Rent and housing still stubbornly high here. And look, you can thank the Federal Reserve for bailing out the banks. You can thank the state governments that are bailing out insurance companies, all things that if these actions weren't being taken, housing would get cheaper in the United States. But, politicians always talk about how they want affordable housing and they want cheaper houses, but really they don't, because nobody wants to be the guy in office when the middle class watches all of their home equity wealth go up in smoke in the form of a housing collapse. So they all talk about paying lip service to affordable housing, but they don't really care about it. And last but not least, transportation services went negative. Now, that's a category that was very important to the Federal Reserve a few months ago or last year when they were talking about super core inflation. Transportation services was one of those categories that was stubbornly high. We got our first negative number in transportation services on a month-over-month basis. The big contributor there is airline fares. Now, just yesterday, we were talking about Delta Airlines lowered their profit warnings. American Airlines lowered their profit expectations. Southwest was adding fees for checked bags for the first time ever in the company. Things in the airline industry are not good right now. You can see it showing in the CPI as those transportation services went negative. The pain in the airline industry is real. Now, all that being said, there's a lot of early recession indicators hiding in this CPI report, the vehicles, the airline fares, the food away from home. That being said, let's take a step back from this and realize 2.8%, that was the headline year-over-year inflation, still well above the Federal Reserve's arbitrary 2% target. They have not hit that 2% target once since the vid, not once since this whole thing started. And yet we're already like coming out of another easing cycle that they're talking about slowing down. They will not overshoot to the downside even a little bit. Inflation, despite coming down, it still remains too high. Life continues to get more expensive for the average person whose wages have not kept pace with their cost of living. And interestingly enough, this may be our only low CPI for quite a while. And I use the word low relative. Again, don't jump down my throat, because the tariff thing, the T word, we got to talk about it, guys. Because tariffs were not reflected in this CPI, but they will be reflected in subsequent CPIs. Maybe it doesn't show until April, probably won't show up in the February CPI or the March CPI yet, but it's coming. And yesterday was kind of a circus when it came to tariffs. Now, when we were doing this stream yesterday morning, we were talking about how Ontario had placed a levy on electricity exports to the United States. And somebody very astutely pointed out in the comments, what happened with Ontario and electricity yesterday was not a tariff. They put a tax on exports, not a tax on imports. A tariff is a tax paid by the importing country on exports from other countries, things being brought into the country. That's not what Canada did yesterday. All right. And I noted that was kind of unusual because Doug Ford is he's a premier, kind of like a governor would be here in the States. And it's weird to see a state governor or a provincial premier getting involved in international politics. It kind of struck me as a low-level guy trying to like punch above his weight class. It was a circus. And of course, President Trump is an easily baited man, so he jumped right into the circus. And the tit for tat back and forth yesterday was just a CF. It was dragging the market down along with it. And then as quickly as it began and escalated, it was over. First things first, Ford comes out yesterday and says a 25% levy on electricity exports to the United States from Ontario, okay, in retaliation for tariffs on steel and aluminum that President Trump had put in place. And in retaliation for Ford's retaliation, President Trump comes in and says, you know what, I'm going to double those tariffs on steel and aluminum if you think you're going to go ahead and put these levies on electricity. No problem. And then he goes and declares an electricity emergency, trying to bring back coal plants, saying it's unacceptable that the United States is buying electricity from other countries. By the way, it is. We're supposed to be one of the most energy-producing countries in the world, and it's laughable that we can't produce our own electricity. Didn't we freaking invent electricity here? But I digress. On top of that, in response to Trump's response to Ford's response, Ford comes out and he says, you know what? Screw the levy on electricity. I might just cut off all electricity exports to the United States entirely. I might just say, no, open up the breakers, shut off the power. And then in response to that, response, Trump comes in and he starts saying, I am going to lay such tariffs down on Canada. They'll be writing about it in the history books. I'm going to permanently kill the Canadian auto industry. Dogs and cats living together, mass hysteria. And then Ford said, you know what? I talked to Howard Lutnick. This was all just an unfortunate misunderstanding, and I think we're gonna back away. And it was over. And all of a sudden, Ontario is not going to put their levies on the electricity they're selling to the United States. And President Trump is not going to double the steel and aluminum tariffs. It was over as quickly as it began. It was a circus between the U.S. and Canada yesterday. And now here's what didn't get a lot of coverage, but it was important. Like beneath the back and forth between Trump and Ford, there was some things that were discussed that were not part of that back and forth. Like Canada was talking about the possibility of selling U.S. treasuries. Canada holds about $378 billion worth of U.S. government bonds. All right. Now, Canada cannot compete tit for tat with the United States in a tariff war. They just can't. They don't export enough to the United States. They are much more dependent on exports to the United States than the United States is on exports to them. All right. They lose first in a war of attrition. Nobody wins, but they lose first. So they need to do something a little bit more creative if they really want to fight this war. And the bond market is a potential front that they could open up. If they were to dump U.S. treasuries, that would drive up the interest rates on those U.S. treasuries at a time when the Treasury Secretary and the president want interest rates lower so that they can reshore manufacturing. They also want a cheaper dollar. And yesterday, Canada filed to issue U.S. dollar denominated sovereign bonds. So Canada decided to fight us in the bond market and in the Forex market yesterday as well, or at least they were threatening to. Now, here's the thing. That's like pulling the pin on a grenade when you're locked inside a small room with somebody, because all of those things Canada was talking about doing would be horrible for things like Canada's pension system, which is largely invested in U.S. treasuries, which go down in value when the government dumps them. And of course, Canada's banks are largely invested in U.S. treasuries and very vulnerable to price swings in those. They're all sitting on huge piles of unrealized losses. So Canada did kind of tip their hand a little bit on where this trade war might go if things get worse. Thank God they stepped back from the brink yesterday. And then this morning, Europe is like, well, wasn't that fun? Hold my beer. Now Europe is saying we are going to put retaliatory tariffs in place on the United States. Rinse, repeat. Oh, it's going to be great. You're just going to love it. Tariff talk is front and center once again this morning. Also, we got a Ukraine deal yesterday, or the early makings potentially of a Ukraine deal. The U.S. and Ukraine reached a deal in Saudi Arabia for a 30-day ceasefire, not an end to the war, a ceasefire. Hey, let's stop shooting while we figure out how to end the war. It's a step in the right direction. Now, Ukraine has accepted it pending Russia's acceptance. Russia has yet to accept. They issued a strongly worded maybe a few hours ago, but it would be a 30-day ceasefire pending Russian approval. Also, the U.S. will put security assistance and intelligence sharing back in place. They lifted the pause, which is kind of like, okay, Russia, here's the stick. We strongly suggest you accept this deal because we're going to start providing targeting data to the Ukrainians again, which is not very good for your tanks and ships. So a little bit of stick involved there. And the minerals deal was also part of this one. So, look, I don't know what's happening there. It's a step in the right direction. I don't know how big a step. We'll see what the Russians say. And, of course, the Europeans will eventually get involved. And we got mortgage data out this morning as well. Rates continuing to head lower. The market still likes it. We got a lot to talk about, guys. Why don't we shrink my big melon of a head? And let's see what is going on in the markets this morning. Don't forget that like button for the YouTube algorithm because we do this every day. And if you're new here, hit that subscribe button. And come on back tomorrow and have your coffee with the melon heads. Right now, the S&P is positive by about 57 points, 1% higher. Look here, guys, we got a big candle right on the CPI release. The algorithms bid up the market and then immediately sold it right back down. You got to be careful trading around these CPI reports. It's all computer driven. But right now, the market is heading higher and it looks like continues to head higher, although it gave up some of its initial gains. The Dow is higher by about 245 points or 0.6% higher. Same thing, big candle at the CPI release that was subsequently sold. And the same thing for the NASDAQ, although it is higher by more than the other indexes this morning, 282 points to the upside, or just shy of 1.5% higher for the NASDAQ. So stock's getting a little bit of a bounce here yesterday. We'll see if it holds. The market is due for a bounce here, long overdue. Meanwhile, we have a slightly stronger dollar here, up by about 30 basis points, 103.71. Looks like the surging euro and the surging yen may be taking a break here this morning. So that's going to put a little bit of downward pressure on stocks, not a lot. And looking over at the bond market, we have got yields are higher across the board this morning. Remember, guys, higher yields, that's people selling bonds. We got the 30-year Treasury 4.627. That's higher by about 2.5 points. The 10-year 4.320, higher by about 3 points. The 2 years at 3.993, almost 5 or over 5 points higher. And the 1 month at 4.304, essentially unchanged here. So I got a little bit of bond selling this morning. Looking over at the commodities board, we've got gold is flat, down $2 here, $2,913 for spot gold. That's off by about 0.1%. My favorite of the shiny, silver, is up this morning. We got spot silver at $32.98, up by about 4 cents or 0.13%. I like the shiny. Copper is up by about 2.3%. Platinum is up by 2%. Palladium is up by about 0.9%. And West Texas Intermediate crude is at 67.19. That's up by about $1 this morning or 1.4% higher. Mixed bag for commodities today. Bitcoin had a good day yesterday. Not quite good enough, at least not yet. $83,565 as priced on Coinbase right now. That's higher than we were yesterday. But we got to zoom in here because we are right at that all-important technical level of the 200-day moving average, which is right where we failed yesterday. And once again, we're at that level. We're trying to break back above that one. So an important level here. You want to see, ideally, what you want to see is Bitcoin move above this and then retest it and then move higher. But right now, what we're doing is breaking down, retesting, and failing lower. So important technical level for Bitcoin here. We'll see where this one goes. All right, let's talk inflation data here. The annual inflation rate in the U.S. eased to 2.8% in February, down from 3% in January, and below forecasts of 2.9%. So if we're looking at a one-year chart of CPI, this is the first relief. And again, I use that term lightly, relief, because prices are still going up. But this is the first month they've gone up slower since September. All right, we've had 4 consecutive months of higher inflation, finally getting a little bit of a step change down. I don't think it's going to last. The tariffs are coming. We're going to have another step change up in CPI when they hit, but we'll see. It's probably going to be short-lived, but at least for the time being, it's no longer trending in the wrong direction. Now, that's the headline year-over-year number. Here's your month-over-month number. It was actually a pretty big change, a big step change down for the month-over-month number. Remember, it's still positive, so price is still going up, but going up significantly slower than last month, 0.2% month over month versus 0.5% in January and below the expectations for 0.3%. Again, the first time in months that we've seen this move lower. So headline numbers, both lower than expected and lower than January. And it's the same thing in core inflation. Looking at the core inflation rate in the United States, finally heading lower here, 3.1% for the month of February. Now, this strips out volatile food and energy. Now, the market was expecting 3.2%, which is a little bit lower than we had last month, but we are actually down by about 0.2%, significantly more than the 3.3 that we had in January. So core inflation heading in the right direction. But once again, guys, I would remind you that the Federal Reserve's arbitrary target is 2% inflation. And, well, how's this looking? Does this look like we are moving sustainably toward 2% right now? I mean, I guess eventually this chart will reach 2%, maybe sometime, hopefully before the end of my life. I don't know, 2055, we might hit 2% at the current rate of decline. We have not seen the 2% target since March of 2021. Hey, no rush, J-Pow. Take your time, right? I mean, we certainly wouldn't want to overshoot by 1/100th of 1%, not after driving up the cost of living by 30 to 40% for the average person, all while telling us it would be transitory. Yeah, how's that transitory working out? On a month-over-month basis, core inflation, 0.2%. That is below the 0.3% expected and down sharply from the 0.4% last month. So look, guys, any way you look at it, inflation was a beat. CPI lower than expected by every metric, and lower than January by every metric. Now, let's look at the chart and see where the inflation was. All items, 2.8%. There's your year-over-year number right there and your 0.2% month-over-month number. Notably, food went down from 0.4 to 0.2 on a monthly basis. Big drop in the cost of food. On a year-over-year basis, it's still 2.6%. That's still pain felt by the average person. But the important thing, food at home, unchanged, 0.0%. Food away from home, 0.4%. So food still getting more expensive, just not as bad as it was. Energy was actually a negative on a year-over-year basis. So energy got a little bit cheaper. The biggest category in the energy subcategory was fuel oil, down 5.1% year-over-year, despite a 0.8% monthly increase. Let's then look at all items less food and energy. That's your core inflation. That one came in at 3.1%. All right, that is down from last month. We were 0.4 on a monthly basis. Now we're 0.2. Interesting numbers within core inflation. New vehicles, we actually got a negative number on both monthly and annually. Negative 0.1 for the month, negative 0.3 for the year. They're just not making enough vehicles, and yet the prices are going down. That just goes to show you the weakness in the auto market, and that's another big-time recession indicator. When the automakers are cutting production and the price is still heading lower, that is not a good sign. Now, meanwhile, used cars and trucks still getting more expensive, albeit at a slower rate. We were at 2.2% in January. Now we're at 0.9%. So prices still going up, but going up slower. And on an annual basis, 0.8%. Also of note here, we got shelter. The monthly number declined from 0.5 to 0.3, but remains stubbornly high at 4.1%. Rent, owner's equivalent rent, continues to be one of the biggest inputs to the CPI, and it's just not going anywhere. I'm sorry, shelter was 4.2% on an annual rate, 0.3% for the month. And another important one, guys, was transportation services, negative 0.8% for the month. That's the first negative number in a long time I've seen in that category. And that is being driven by your airline fares. That's something we talked a lot about yesterday. The airlines are hurting here. They're all coming out with profit warnings because people are taking fewer trips. You've got fewer government employees doing business travel because of the layoffs and the cutbacks. And you've got fewer people taking vacations because they just can't afford life. That is showing up in the CPI as well. But it was a beat. Let's call this one the win that it was. Inflation is at least heading in the right direction. All right, now let's talk real quick about tariffs, guys, because it's back in the news today. I hate this subject. I don't like tariffs, but hey, it's in the news. We got to talk about it. Trump halts doubling of tariffs on Canadian metals after Ontario suspends electricity price hikes. And after all of the back and forth and all of the bluster yesterday, that is basically what we got. We are right back to where we were when we went to bed the day before. All that stuff, all that yelling, all the it was all for nothing. President Donald Trump's threat Tuesday to double his planned tariffs on steel and aluminum from 25 to 50% for Canada led the provincial government of Ontario to suspend its planned surcharges on electricity sold to the United States. They don't want to say it because it might help, or it might make Mr. Orange look better or whatever, but this was Ontario blinking. I mean, it was a CF, it was a circus, but at the end of the day, Ontario blinked. As a result, White House trade advisor Peter Navarro said the U.S. president pulled back on his doubling of steel and aluminum tariffs, even as the federal government still plans to place a 25% tariff on all steel and aluminum imports starting Wednesday. So that original tariff that started this whole tit for tat, that's still going forward. The drama delivered a win for Trump, but also amplified concerns about tariffs that have roiled the stock market and stirred recession risks. Tuesday's escalation and then cooling in the ongoing trade war between the U.S. and Canada only compounded the rising sense of uncertainty of how Trump's tariff hikes will affect the economies of both countries. And, guys, I think some of the sell-offs we had earlier this week, I was theorizing that it may be driven more by what's going on in Europe and what's going on in Japan. Yesterday, however, was definitely all about the tariffs. The market did not like what it was seeing between the U.S. and Canada. And of course, now that that's all done, the EU is like, cool, let's do that again. My turn. EU targets 26 billion euros of U.S. products in tariff retaliation. Here we go again. The European Union launched countermeasures on Wednesday against new U.S. metals tariffs with plans to impose its own duties on up to 26 billion euros or $28.3 billion worth of American goods. The announcement came hours after the U.S. administration imposed 25% tariffs on steel and aluminum imports in a massive escalation of the trade war between the longstanding allies. The EU will target politically sensitive goods in Republican-led states, including soybeans from Louisiana, home to House Speaker Mike Johnson, according to a senior EU official. EU metals tariffs that had been put in place during Trump's first term and later suspended are due to be reintroduced in full on April 1st. Including some levies that have never previously been in force. So, yeah, Europe's like, yeah, let's do that again. All right, good luck. I'm sure the back and forth is just going to be as wonderfully entertaining as it was yesterday. Also, speaking of politically charged subjects, the House has passed a bill to fund federal agencies through September, though prospects are unclear in the Senate. This is the ongoing budget battle and the government shutdown circus again. It looks like the House made a little bit of progress yesterday. There was one Republican voted against it and one Democrat voted for it. Here's the important thing. Let's skip all the politics and get to the numbers. Lawmakers said the bill would trim $13 billion in non-defense spending from levels in the 2024 budget year, but increase defense spending by $6 billion, which are rather flat changes for both categories when compared with an overall top line of nearly $1.7 trillion in discretionary spending. All of that back and forth, all of that silly posturing for a measly $7 billion in net cuts on a $1.7 trillion discretionary bill. It is quite literally impossible to cut spending in the United States. The bill does not cover the majority of government spending, including Social Security and Medicare. Funding for those two programs is on autopilot and not regularly reviewed by Congress. Oh, that's right, the biggest spending programs in the country. We're not even allowed to talk about cutting those. Nope. $6-7 billion worth of cuts total. That's all we got. Oh, and by the way, it's still got to get through the Senate where they need 8 Democrats to vote for it in order to get it passed. Guys, the spending situation, it's not getting better. It's going to get worse before it gets better. And this is just talking about freezing at 2024 levels, which were obscenely high deficits. Meanwhile, Moscow is wary of jumping the gun after the U.S. and Ukraine unite over a ceasefire deal. Unite may be a little bit of a strong word here by CNBC, but the big question here is, what will Russia do? All eyes were on Moscow on Wednesday morning as the Kremlin broke its silence and delivered its initial reaction to Kyiv on the White House's unilateral agreement proposing temporary ceasefire to the ongoing war in Ukraine. Talks between U.S. and Ukrainian officials in Saudi Arabia on Tuesday ended with Ukraine agreeing to an immediate 30-day ceasefire negotiated by the U.S., but Russia must still accept the measures. That's right, the enemy gets a say. As part of the plan, the U.S. will lift its pause on military aid to Ukraine and restart the intelligence sharing it had also halted in recent weeks. Now, that's important right there, guys. Lift the pause, which means we're going to give them things that go boom again, and we're going to start giving them the targeting data again. All right, so there's a little bit of stick involved here. They're saying, hey, Russia, all right, we pulled the aid to the Ukrainians in order to get a deal cut here. Now we've got the Ukrainians have agreed to a deal. If you don't like this deal, we're going to start giving them the stuff that goes boom again. So I don't know if this is going to work or not, but that's at least the tactics that are being used. On Wednesday, the Kremlin issued a cautious response to the development, saying it needed to hear more details on the plan from U.S. negotiators before it could fully decide whether the proposed ceasefire agreement was acceptable or not. In other words, a resounding maybe. That's what we get. We got a maybe. All right. Hey, maybe's not a no. Let's take the win. Let's call that one a W. All right. It's a maybe. Are we going to keep killing each other tomorrow? Maybe, maybe not. It's better than we were yesterday. A little bit. All right. Also, we got 30-year mortgage data today. The average contract interest rate for a 30-year mortgage in the U.S. with conforming loan balances declined again to 6.67%. That is down from 6.73. So we got another 6 basis points of drops in mortgage rates. And you can see here, not as big a fall from the week before, but mortgages continue to get cheaper as the interest rates in the bond market continue to come down. And, well, home buyers seem to be liking that. Mortgage applications in the U.S. rose by 11.2% from the previous week for the first period of March, extending the 7-week surge of 20.4% in the last period of February. Applications for a contract to refinance a mortgage, which are more sensitive to short-term changes in interest rates, soared by 16% after the 37% surge in the prior release. In the meantime, applications for a mortgage to purchase a new home were also higher by 7%. That is the second consecutive increase. So, guys, the housing market remains very responsive here to changes in interest rates. Now, these are applications. That's important. These are not necessarily deals that are going through. This is just people asking for a mortgage. Rejections are also very high. So this doesn't necessarily translate to a healthier housing market, but it certainly doesn't hurt that the applications are rising. And another one, we didn't get to this one yesterday, but this is an important earnings, I think. Oracle won some big cloud contracts. Here's why the stock is falling. Now, Oracle is one of those, we'll say one of those second-tier, big-time AI plays. And Larry Ellison and his executive team over there, they are like the kings of overpromising and under-delivering. They're holdovers from the dot-com boom. And that's why I think Oracle earnings is worth a mention here. Oracle regaled Wall Street on Monday with talk about the future, enormous demand, and some very large cloud service contracts. But its stock continued a downward trend over concerns about growing costs associated with building out more data centers. Shares of Oracle, despite initially heading higher after the company's earnings report, came out and fell 3.1% on Tuesday. The report showed that the company's fiscal third quarter earnings missed Wall Street expectations. After all of the bluster about data centers and the insane demand and, we're building all these nuclear plants, even though we're not giving you any details and the NRC hasn't approved any of it. Yeah, we're just saying a bunch of things. After all that, they come out and they miss expectations. Oracle shares surged last year amid the AI boom, but are down 14% in 2025. Oracle's guidance for the fiscal fourth quarter was also below Wall Street expectations, implying fiscal 2025 revenue growth of 7.5% to 8%. Versus prior commentary of double-digit growth, so they're guiding lower too. The company's report was a mix of big positives and some negatives. Among the biggest was the news that the software giant had $130 billion in backlog contracts for cloud services. Yeah, that's a great big number, but remember, a backlog contract is something that hasn't been paid yet. You haven't actually sold it yet. In addition, Oracle's expected revenue from the Stargate data center contract announced earlier this year was not included in its estimates. Maybe that's because Project Stargate was just a silly media stunt and didn't actually have any substance behind it. Hey, I just throw it out there. You guys do what you want with it. But Oracle stock, it's up. It was down yesterday about 3.5%. It's now regained about 2% of that. The opening bell just rang, $147. But year-to-date, Oracle stock now down about 13.5%. It has joined in this big tech sell-off that we have seen for the better part of the last month. And I just want to say thank you very much to Harmonair LLC. Thank you, Harmonair, for the super chat and support of the channel. He says, don the tinfoil hat. We certainly won't dusk the tinfoil hat. He says, don the tinfoil hat. So maybe the sudden drop in airline fares might have something to do with all the plane crash news from the past months on MSM. Harmonair, I would say absolutely it does have something to do with it. Now, I don't think there's a lot of substance to a lot of the plane crash news. I do think a lot of that has been an overly emotional reaction. Statistically, the numbers in the accidents that are happening are not any more severe than prior years, but the coverage certainly has been. And even it was either Delta or American yesterday when they announced their results and their cut to profit. One of them specifically called out that travelers are reacting to the perceived increase of risk in air travel that has happened. And they called out that accident in DC, that midair collision, which, by the way, was not the fault of commercial aviation. That was the fault of a military aircraft that flew right into the path of a jet that was landing. And it really says nothing about the safety of commercial air travel. But that being said, yes, I don't think we necessarily need the tinfoil hat, but I am happy for the product placement opportunity. Absolutely, the perception of increased risk in air travel is playing a role here in the lowering of profit expectations for the airlines, and I think of the CPI and the cheaper airfares that are showing. Very good comment, Harmonair LLC. Thank you for the super chat, the support of the channel. And the angry agent. Well, look out, he looks pretty angry. All right, angry agent. Didn't Trump rewrite NAFTA and create USMCA in 2018? How is the U.S. getting screwed when Trump crafted the agreement? All right, yes, we did rewrite NAFTA. The USMCA stands for U.S. Mexico Canada Agreement. That was the last time the U.S. and Canada and Mexico were playing their tit for tat, tariff for tariff in Trump's first term. And they did pass an agreement. Now, it was just a few days ago that USMCA played a role because the tariffs were going to go in effect in the beginning of March, and it was about 60, high 40s, low or mid 50s. We'll say half, about half of the proposed tariffs are on goods that were covered under USMCA, and Trump punted on those until April 2nd. So yes, USMCA is playing a role here. Trump has postponed the tariffs on that to try to preserve that agreement. How is the U.S. getting screwed when Trump crafted the agreement? Look, I don't want to get into the politics of it all. I would say 100,000 people a year dying from fentanyl that is coming into this country. I think we can clarify that as screwed. 100,000 people a year. And let's be honest, guys. Yeah, you can say what you want about avocados. The single biggest export in Mexico is death and destruction into the United States. Hands down equivalent. I mean, drive down Kensington Avenue in Philadelphia and look at the number of people who are just human statues, just sitting there hunched over, drooling on themselves. And there's a Kensington Avenue in every city in America. All right. And look, I grew up in the DARE program and, what was his name? Escobar and the Colombian coke cartels in the 80s. On their worst day, they never stacked bodies like fentanyl did. There has never been anything in this country quite like the fentanyl crisis. And it's not just a Mexican thing, I would add. American pharmaceutical companies were absolutely, I'd say half responsible for this fentanyl crisis because they created the pipeline of addicts by telling us that the painkillers that they were feeding us were not addictive when obviously they were. But guys, what's going on with fentanyl, there's never been anything like it. I mean, in all the dare to keep kids off drugs history of the United States, it has never been even close to this bad. And that's how the U.S. is getting screwed. Now, you could also argue the United States creates the demand, so maybe it's more a U.S. problem, and that is a perfectly legitimate argument that is worthy of being hashed out. Probably not the time nor the place to have that conversation, though. But you're right to point out USMCA, Angry Agent. That is playing a role here, and that's why the tariffs were delayed. All right, guys, I just want to say thank you so much for the super chats and the support of the channel. Also, thank you to my magnanimous melonheads on Patreon and YouTube. You guys are awesome. Thank you for supporting the channel. Links down below, should you feel so inclined. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.